What's up guys, Malik here, welcome back to the channel. So I titled today's video, Can You Time the Market? So while many may say it's a fool's errand to do such, I see a possibility there if we understand what those that control the money supply are saying, i.e. in this example the Federal Reserve for US stocks, because that's what I focus on. Alright, so some key terms I want to introduce you to before getting into the video are as follows. So, interest rates. So, what is an interest rate? An interest rate is the amount of interest due per period as a proportion of the amount lent, deposited, or borrowed. Alright, so interest rates. What is an interest rate cut? When interest rates go down, borrowing becomes cheaper, making large purchases on credit more affordable, such as home mortgages, auto loans, and credit card expenses. Alright, next one, interest rate hike. And I will leave this link in the description as well, so you can click on it and actually see, you can actually go back through it and see the links that I use and see the definitions. So what is an interest rate hike? Interest rate hike is when rates go up, borrowing becomes more expensive, putting a damper on consumption. Higher rates, however, do benefit savers who get more favorable interest on deposit accounts. So interest rate hikes actually create less demand in the economy, less consumption, kind of slows down the economy, slows down the demand for certain goods, certain commodities, certain assets, all of that. Quantitative easing. So quantitative easing, also known short as QE, occurs when a central bank buys long-term securities from its member banks. The securities are generally either stocks, bonds, mortgage-backed securities. So when the Federal Reserve, which is the central bank in the US, buys these securities, they add new money to the economy. As a result of the influx of new money, interest rates fall, making it easier for people to borrow money, and it really causes a slush of money in the economy. There's a lot of money chasing the same amount of goods or the same amount of assets. That's what happens when you have quantitative easing. And lastly, quantitative tightening. Quantitative tightening is the opposite of quantitative easing. So it's a contractionary monetary policy tool applied by central banks to decrease the amount of liquidity within the economy. So what I'm going to do now is actually look at the news times when the Federal Reserve actually implemented some of these strategies, and then look at them on the chart to see maybe we could have timed the market in a way if we just understood what they were saying. So I'm actually looking back at the data now and trying to put the pieces together and understand it more. So going forward, anytime they say something similar to this, we have more conviction to take a stronger action, and we don't miss a run-up or we don't miss a sell-off. We know exactly what the market tends to do when the central banks make certain moves. All right, so let's get into it. So if we go back, this is a news article from CNBC, and then here we see the Federal Reserve Board announce an emergency rate cut on Sunday, March 15, lowering interest rates near to zero. Okay, so what is an interest rate? When they lower interest rates, it's same as an interest rate cut. So when rates go down, borrowing becomes cheaper, making large purchases on credit more affordable, such as home mortgages, auto loans, and credit card expenses. It actually incentivizes people to spend their money, to just get out there, buy assets, buy things, consume things, So if we go to the chart, and what I'm going to focus on are the two main asset classes I want to focus on, that you can actually see where the liquidity came in. So I'm focusing on the S&P 500 and also Bitcoin, of course. So if we were to go to the chart and go to around March 15, March 16, right here, this is around the bottom of the market when that happened. So we had the sell-off from COVID from where February 18 here, come right down, you gap down to when the Federal Reserve decided to step in around March, what was that, March 15. So they made the announcement March 15. March 15 was probably the top here, and then you come down March 16, the market start to react, the market getting more liquidity, and you can see from there you just had straight run up. You just had a lot of liquidity in the market right up until no later down into the market, but we'll get more into that. But you see, if you had known that when the Federal Reserve cuts rates, you would have seen that, all right, the market just rallies, the market goes up. That's when you see a lot of risky assets go up. You just see everything go up in the market because there's a lot of money in the system. And when there's a lot of money in the system with the same amount of assets, the same amount of goods, that causes the prices of everything to go up. The prices of regular goods, the prices of cars, the prices of homes, the prices of desirable assets also tend to go up because there's a lot more money in the system chasing the same amount of goods. Pardon me. So if we were to go to Bitcoin, and I think there's something about crypto, it's like Bitcoin is showing the true demand and supply equation. Like if there is a rate cut or a rate hike, I think Bitcoin actually shows it immediately versus the regular institutionalized assets that have a backing from big hedge funds, big company, and also big players in the field. So Bitcoin here around February 18, the same thing with Bitcoin, it saw a huge sell-off down to around 36,000, and then you can see it had the same reaction when the Federal Reserve stepped in and said emergency rate cut around March 16. That was the bottom. So this is the COVID sell-off, and then as soon as you have a rate cut, you can see you just have a trend up and up and up and up, and you probably saw that happen. All right, so that's where I'm saying if we look out for certain triggers, we'll know what moves to make. All right, that's why I'm saying, is it possible for us to time the market? My theory is I think there is something there. So also you can look here, I'm looking at a press release from the AmericanActionForum.org. So they also talk about QE here, which is the same as the rate cut. So the same or similar. All right. So in addition to cutting the federal funds rate to zero, the Fed also announced a new round of QE, which is a controversial tool for boosting the economy. The last employed in a significant way as a result of the 2007 to 2008 financial crisis. So quantitative easing is also known as large-scale asset purchases. Typically involves a central bank itself purchasing the bonds and other long-term securities, right? So if you were to look at bonds is TLT, right? So if we were to go to the March 16, TLT, this is long-term bonds. So you saw a huge run up here. I'm pretty sure this is when the Federal Reserve was buying up bonds. Oh, no, my mistake. So people then generally go to bonds for safety. So you can imagine the economy is crashing. People don't know where to go with their money. They head to bonds, right? The economy is crashing. Everybody is trying to get their money out. Bonds drops down, and then the Federal Reserve has to step in and provide some backing here. So the Federal Reserve provides some backing here and start to buy bonds here. So I'll show you another example on the flip side as well. So if we were to go to November 3rd, right? So this is the opposite now. This is when the Federal Reserve is start to mention that they are going to go above for the interest rate. So there's an interest rate possible hike, right? And then you also see they are going to reduce asset purchases. So they're going to start quantitative tightening. So that's when I think we could have known that this was the top of the market. So, right, 18 months after initiating emergency actions that include slashing the interest rate to 0%, right? The Fed has, let me skip, I don't want to go too much, but the Federal Reserve at last announced that it will begin the pullback on supporting the economy, with the first step a reduction in the rate of asset purchases through the quantitative easing program, right? So this is when the Federal Reserve said they're going to stop supporting the economy. They're starting to pull back. That's when we could have picked up that, all right, they're going to ease now. They're going to ease on the purchasing of the assets, and they're going to begin to raise interest rates as a way to reduce inflation and to have the economy work on itself and get back to normal. So if we get back to November 3rd, we want to look on the charts for this exact date to see if the charts were showing us anything, right? So November 3rd. Let's go to November 3rd here. So November 3rd, that's around here. So November 3rd, you'd have had a little run up here, but this is a point where you could have entered and said this was the top of the market, because you understand what it meant when the Federal Reserve said they would stop the purchasing of assets. So I'm looking at this here. If we began to short the market here, you can make a lot of money if you just knew what you were doing and you were more convicted. I was playing the QIDs, but I didn't really understand. I wasn't as convicted as I should have been, because you could have got the QIDs. Let me even check it out here. So we look at November 3rd QIDs. They were probably pretty cheap, and that's a way that you could have got into the market and made a lot of money from the downside. So QID, and we're going to look at November 3rd. November 3rd, right? So QID was around 16 here. Yeah, not even 16, 15. QID was at 15. So the QID is the inverse of the NASDAQ. So the QID began to see a run up as soon as they start to talk about they're going to do quantitative tightening and they're going to buy less assets. So that's a way that we can profit from the downside if we just completely understand the words they use and what it means. So also, when the Federal Reserve stops buying assets, the assets are generally bonds. So if you look for bonds, which is TLT, let's go to November here. So if they're going to stop buying bonds, and they usually buy, what's this amount here? $120 billion in assets per month. Right? So if you were going to go to the exact date that they announced, which is November 3rd. So let's go to November 3rd. November 3rd. November 3rd. So around here, right? So let's go to November 3rd. Oh, my bad. Go. You gotta go. So November 3rd. Around here. So November 3rd, you'd have had to sit through the entire play. But as soon as the Federal Reserve confirmed that they were going to stop buying bonds, it was almost a foolproof play to the downside. Look at this. So November 3rd, they released it. You'd have had to wait some time, but it would be a foolproof play to know that bonds are going to take a rundown. And you could have played puts to the downside, are also calls on something that's called TBT. So I'm going to look at TBT, which is an inverse ETF. You know, I love my inverse ETFs because they give you a better way to play the downside than just playing puts, you know, in my opinion. So TBT, you look at November 3rd around here. So let's get on it. November 3rd. Right here. So see TBT here, you'd have had to wait a bit, of course, but you see there was a run up that you could have caught. All of this here, if you just understood what was going on, what was the play. So TBT, that is a way that you could have played the downside on bonds as well. And then the final thing I wanted to look on for the correlation between quantitative tightening and the broader stock market or equities market is November 3rd, looking at Bitcoin. As I said, Bitcoin shows you the pure demand in my opinion. So you see around November, that's when we hit around 69,000. That was the highest Bitcoin has ever been. And that is what you could really call the top, right? So around November 3rd, let's get in down here. So these are 1 week charts. So what candle is November 3rd? So November 3rd would be within this candle, of course. And that's around 64,000. And that was the clear top around November 3rd, 2021. That was the top of Bitcoin. You could have shorted it to the downside, just understanding that a tightening monetary policy would have caused asset prices to fall. We can even look at November 3rd on the SPY. On the SPY or the NASDAQ. So the NASDAQ is QQQ. This is an ETF that tracks the NASDAQ. And if you were to go to November 3rd around here, you can see it's the same thing. It's close to the top of the market. You're not going to time it perfectly, but if you get the range and you're right, you make money. So here we have where November 3rd would be within this 1 week candle here. And that was basically the top of the market. You wouldn't have this hit you out. You just try to get all of this downside here, all of this downside. So you'd aim to get all of this. You aim to get all of this. Oh, come on. You'd aim to get all of this. Not really worry about this small, what do you call this, a pullback or a drawdown. You're aiming for more of the downside. And there's possibility that there is even more downside. So that's why, from my theory, I believe there's a possibility for you to time the market if we just understand what certain terms mean and when the people that control the money say it. And if you look around here, this is also March 16, March 15, which was also the bottom of the market that started the run-up that we have right up until November 3rd, when they released that they're going to do quantitative tightening. So if we were to just put some, what can we put here? Like an arrow here. So right around here would be, this is quantitative easing. And if we go right up here, where's the down candle? Right here, November 3rd. So that would be quantitative tightening, quantitative easing, quantitative tightening. So let's zoom it out. And you tell me what you think. Do you think we could have timed the market just by knowing that right here, when they said quantitative easing, the market would have run up? And right here, when they said quantitative tightening, the market would have sold off just as we are right now. So thank you for watching the video, and let me know in the comments what do you think. Also, I'll leave this in the description and you can check it out. I have all the links that I used here and also the charts that I used here. Thank you and see you in the next one.